Hi, I'm Ed Marsh. Welcome to this episode of Signals from the OP. I create these brief videos every couple of weeks to provoke some thinking for industrial manufacturing company executives. If you know of one who you think might find some value in this, please share it with them. Today, we're going to chat about revenue attribution. Now, I'm sure you've heard the aphorism, I know that half my marketing spend is wasted, I just don't know which half. Of course, back when you'd run Yellow Page and Thomas Register Green Book ads, that sort of made sense. You could always hope that your folks would remember to ask and document the lead source, and that your reporting would capture it. You could use different toll-free numbers and try to associate lead sources, but it was hard, nigh on impossible to really know. Of course, any brand spend is inherently uncertain too. But for the sake of this conversation, let's focus on lead generation. Specifically, lead generation and predictable revenue for industrial manufacturing companies and capital equipment machinery vendors. Mid-size industrial manufacturers are conservative in their spending on marketing. Many have tried journal advertising, SEO, and content marketing and had disappointing results. While my experience tells me that those disappointing results were almost certainly reflective of poor execution rather than faulty strategy, nevertheless, they're understandably cautious. But experience also tells me that caution isn't resistance, it's hesitance. Most people that run industrial manufacturing firms try to be objective and make empirical decisions. We're all human, but they're generally a very logical lot. When they say they're hesitant to spend much more on marketing than the 1% of revenue they put into trade shows, what they're really saying is they don't want to indiscriminately waste money. If they knew that every dollar spent on Google AdWords returned $7 in gross profit, they'd be setting AdWords on fire. It's hard to argue with their position. It's pretty sensible. So here we get to the meat of the discussion. What we're really getting to is the question of how we can connect specific revenue dollars to specific marketing and sales activities and investments. After all, capital equipment sales teams don't have generous marketing budgets, so connecting dollars invested to their correlated return is a critical capability in the world of inbound sales and marketing because not everything works. And what works with one group doesn't work for another. Further, lots of traffic or leads that drive no revenue could be indicative of various things from fruitless spending to inept sales. Only data will help to guide investment toward activities that work via revenue attribution. Revenue attribution is the process by which sales dollars, or even profit dollars, are tied to specific marketing and sales activities. This helps management do more of what works, less of what doesn't, and to invest in productive programs. But it does something much more important as well. It gives management a set of revenue growth controls. In other words, levers and buttons and data to guide the decisions on which to push and pull at what magnitude to achieve specific revenue outcomes. Manufacturing, marketing, and industrial sales aren't some black box. You should be able to invest tactically in efforts that drive results. Every company should have clarity into what inputs affect what outputs and to what degree in their revenue growth, just as they do in their manufacturing production. That should be at the core of revenue growth strategies, and it undergirds predictable revenue efforts. Now let's be honest, revenue attribution is an imperfect science, particularly at the transaction level. However, in aggregate, it's very informative. So why is there some uncertainty? Well, let's say you have a target account to which marketing has been showing some LinkedIn ads and sales has been running some target account outbound sales playbooks. Maybe somebody from the company attends a sponsored webinar you run with an industry trade journal, and a pair of engineers from the company visit your booth at a trade show. 6 months later, after team selling efforts and lots of sales enablement, you close a deal. So which investment won the deal? The ads? The outbound sales, the webinar, the trade show, the sales enablement? The reality, of course, is that probably all of them in aggregate, and we'll never know exactly. So how do we attribute the revenue? Well, there are a few approaches. One is the first touch, say, the LinkedIn paid ads in that example. Some say the last touch, the sales enablement in that example. Now, those may simplify reporting, but they're really too simplistic for complex capital equipment sales. More realistic is a model that takes all of it into account through some formula. Why is this important? Well, let's take your investment in trade shows. What if a show fails repeatedly to yield enough leads and attributable profit dollars to justify participation? But you find through attribution modeling that engaging with pending projects at that show is an incredible predictor of closed-won deals, and in fact generates enough profit to pay for participation on average. Well, that's valuable information. So whether it's paid ads investment, paying for contracted demand generation services, content creation, sponsor content, your website, trade shows, journal ads, an inbound sales team, public relations, or any other revenue growth investment, you should be able to know what net dollars are generated and what the ROI is for that investment. A dynamically updated attribution report should be on every revenue growth management dashboard and a topic of conversation in every marketing and sales meeting. Revenue attribution must inform revenue growth strategy and manufacturing marketing investment decisions. And your tech stack must support this through marketing automation, inbound call tracking, and thoughtful integration of digital tools into print and physical events, like 2D barcodes or vanity URLs that forward to tracking URLs. Revenue attribution is an example of the kind of process engineering which is common in companies' operations and production, and which we need to bring to their marketing and sales. Revenue attribution tracking and reporting should inform all activities, from revenue growth strategies on down to daily tasks. Not only does it enable sound financial decisions, but it provides the toolkit to make informed decisions on what activities to emphasize to achieve certain revenue objectives. At the bottom line, revenue attribution is fundamental to developing predictable revenue programs. I'm Ed Marsh. If you found value in this episode of Signals from the OP, check out the full playlist. Maybe even like it, share it, and subscribe, either to my YouTube channel, edmarshspeaks.tv, or at the related blog, SignalsFromTheOP.com.